Welcome to TickerWatch. This week, we saw one of the most powerful signals of the AI boom clashing with a wall of investor skepticism. Nvidia delivered a quarter for the history books, with revenue soaring 73% year over year, but in a surprising turn, the stock suffered its worst single-day drop since April of last year. So why did a record-breaking quarter trigger a market sell-off? And is this a sign that the AI euphoria is finally facing a reality check? We'll dig into the numbers, the news, and the narrative. This is TickerWatch News for Nvidia, Week 9, 2026. In this episode, we're breaking down the pivotal developments for the chipmaker, from blowout earnings and a stunning market reaction to massive new investments and a CEO pushing back against Wall Street's biggest fears. It's been a week of mixed messages for the company at the center of the AI revolution. Nvidia's stock experienced a significant downturn this week, closing the period with a notable loss. The week started with anticipation building for its earnings, but even a stellar report couldn't prevent a sell-off. The stock fell more than 5% on Thursday and continued to slide on Friday, wiping out hundreds of billions in market capitalization and leaving it down about 3% for the year so far. Trading volume was heavy, with over 300 million shares changing hands in a single session, reflecting the intense investor focus. This happened in the context of a nervous, broader market. The Dow Jones just posted its worst week of 2026, and the tech-heavy Nasdaq had its worst month since March. There's a clear rotation happening, with sectors like energy outperforming technology for 10 consecutive weeks, suggesting investors are moving toward asset-heavy industries and away from areas they see as vulnerable to automation or overhype. The biggest story of the week was Nvidia's fourth-quarter earnings report. The company posted record-breaking results that blew past Wall Street estimates. Revenue for the quarter hit $68.1 billion, a 73% increase from the same period last year. Earnings per share came in at $1.62, also beating expectations. The driving force was the data center segment, which brought in a record $62.3 billion, up 75% year over year. This confirms that the demand from cloud providers and enterprises for Nvidia's AI chips remains incredibly strong. Looking ahead, the company projected first-quarter revenue of around $78 billion, well ahead of analyst consensus, and notably, that guidance excludes any data center compute revenue from China. Despite these flawless numbers, the stock sold off sharply, signaling deep investor anxiety about whether this level of spending is sustainable. Adding to the complex picture, Nvidia was a key player in OpenAI's massive new funding round. The ChatGPT maker raised $110 billion, with Nvidia investing $30 billion. This follows similar large investments from Amazon and SoftBank. This move tightens the web of relationships between AI developers and their essential hardware suppliers. For Nvidia, investing in a top customer like OpenAI helps secure future demand for its chips. It also highlights Nvidia's expanding role as a core supplier for national-level AI initiatives and sovereign AI projects, diversifying its customer base beyond private cloud companies. In the face of market jitters, CEO Jensen Huang directly addressed Wall Street's biggest fears this week. On the company's earnings call, he pushed back against concerns that big tech's massive AI spending will slow down, stating that in the new world of AI, compute equals revenues. He also delivered a blunt rebuttal to the panic that has hammered software stocks, arguing that AI agents will become huge users of existing software tools, not destroy them. He believes the market has misunderstood this dynamic. Huang also commented on more speculative ideas, noting that orbital, space-based data centers have poor economics for now, but acknowledged their potential long-term benefits, like abundant energy in space. Finally, reports emerged that Nvidia is planning to launch a new processor designed to help customers like OpenAI build even faster and more efficient AI systems. This, combined with news of a new multi-year AI voice collaboration with Google Cloud and 11 Labs, shows the company isn't standing still. It's actively working to expand its product line and embed its technology deeper into the AI ecosystem, from large-scale data centers to specific applications like conversational AI. Investor sentiment around Nvidia this week was a battle between stunning fundamentals and growing fear. On one hand, many analysts were impressed. Wedbush argued the sell-off has gone too far, and Zacks maintained a strong buy rating on the stock. On the other hand, the negative reaction to a blowout quarter shows just how skittish investors have become. Michael Burry, the investor known from The Big Short, raised alarms by comparing Nvidia's surging purchase obligations, which have ballooned to over $95 billion, to Cisco's situation just before the dot-com bubble burst. He argues this signals Nvidia is taking significant internal risk by committing to supply far into the future without full demand visibility. This highlights the core debate: is the AI boom a sustainable long-term revolution, or is the industry getting ahead of itself? The market's sell the news reaction suggests that for now, fear is outweighing euphoria, and investors are questioning if the massive spending on AI infrastructure can be justified by near-term profits. From a technical perspective, Nvidia's stock has been trading in a relatively narrow range for the past few months, and the post-earnings sell-off has pushed it back down within that range. It remains below its recent peaks, reflecting the market's current uncertainty. On the fundamental side, the picture is complex. The growth story is undeniable, with revenue up 73% year-over-year. Valuation has also become a talking point. With the stock's recent drop, it's trading at less than 22 times forward earnings. That's cheap compared to its 5-year average, and roughly in line with the broader S&P 500, leading some to argue it's a growth at a reasonable price opportunity. However, the risk narrative is gaining traction. Key concerns include the sustainability of hyperscaler spending, high customer concentration with over 90% of data center revenue coming from just a handful of cloud providers, rising competition from AMD and in-house chips, and the ongoing exclusion of China market. Michael Burry's warning about massive supply commitments adds a significant layer to that risk profile. Looking ahead, the next major catalyst for Nvidia will be its GTC 2026, which is just a few weeks away. Investors will be watching closely for details on new products, particularly the next-generation Blackwell architecture and any new chips designed to accelerate AI processing further. In terms of price levels, the key question is whether the stock can find support and rebound, or if the post-earnings dip marks the start of a new lower trading range. The bull case is that this week's sell-off was a short-sighted overreaction. The underlying demand remains exceptionally strong. The stock is now more attractively valued, and GTC will unveil new growth drivers. The bear case is that concerns about an AI spending bubble will continue to mount, and the market will keep rotating away from tech into other sectors. For now, the most likely scenario is continued volatility as investors grapple with these conflicting high-stakes narratives. That's all for this episode of TickerWatch. Thank you for listening. This podcast is for educational purposes only and is not financial advice. Be sure to subscribe, leave a review, and share the episode to stay up to date on the companies shaping our world.